Welcome into America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates. Securities offered through Peak Brokerage Services, LLC. Advisory services offered through the Retirement Guys Formula. Registered investment advisor. America's Retirement Headquarters, America's Medicare Associates, and the Retirement Guys Formula are separate and independent entities from Peak Brokerage Services, LLC. Welcome you into, and thank you so much for joining us here on America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker and Scott Kershner. Myself, my name is Chris Swan. 419-794-3030 is the phone number. It's 419-794-3030. You can find them online day and night, arhq.com. Today on the show, the first step in investing like a millionaire. If you're planning on working in your retirement years, we'll talk about whether or not that might be wishful thinking and how can an estate plan help family disagreements? All this and more. But first, before we get into it, let me check in with the guys. Nolan, Scott, glad to be with you. How you doing?
Doing wonderful. It's nice to finally get some nicer weather here. Sure. And with this weekend, I just want to say a big shout out, if you will, to all the mothers out there. Happy Mother's Day.
Yep. Amen. Happy Mother's Day. That's an important time. And I know you had some exciting news. Andrew graduated from college here a couple of weeks back, and he is officially a full-time employee now starting last Monday, right?
He is in the big leagues.
He's in the big leagues, yeah.
So he's been here for the last couple of years, obviously going to college, but did finish up his degree and double majored in finance, business management, and last week I was helping him get registered to take his certified financial planner designation exam. So he is a go-getter, and I'm glad to have him on the team as one of the retirement specialists here.
Very exciting times here at America's Retirement Headquarters. So congratulations to you and to Andrew. And again, just to reiterate what you guys said, happy Mother's Day to all the moms out there. Incredibly important job that I don't think gets quite enough accolades out there. But let's go ahead and dive into this week's show. We've quoted Warren Buffett before in the past when he said, bonds should come with a warning label. But with the possibility that interest rates may go down at some point this year, has he changed his mind? According to Barron's, well, no. The Berkshire Hathaway portfolio was only 1% in bonds, and that part of the portfolio lost around $3 billion with a B dollars last year. Bonds are built for income and as a hedge against market losses. Where can you currently find those qualities if bonds aren't it?
Well, when you look at bonds, you think of the traditional asset mix. A lot of people that are listening probably have some type of target date retirement account if they have a 401k. And if you do, I think this is the segment for you. If you own things like a variable annuity, a lot of those variable annuities require some type of component to be invested inside of a bond. And bonds come with actually a lot of risk. In fact, if you go to Morningstar.com and you look at the aggregate bond index, even this year in 2024, as of May, that index is still negative this year. So, Warren lost in that example $1 billion on bonds last year when it's just a tiny part of his portfolio. If you look at some of these target date funds that are out there, they're not putting 1% allocation in bonds. They're putting 40, 50, 60% in bonds. I had a gentleman who come in the office the other day. We did an analysis on his retirement account. He's, about a year away from retirement. He's in one of those target date funds, and he feels like, I just never seem to be going anywhere in my account. And when we looked at the target date fund, what we found is that such the large percentage that he had was just a drag on his portfolio over time. So the question is are bonds really good for you? What you want to understand is what are the risks associated with bonds? One is that you have interest rate risk. And so where a lot of people have gotten clobbered with bonds in the last 2 years is because the interest rates have gone up so much. And when interest rates go up, bond prices generally go down. The perception is that interest rates are going to go down here in the future. And I might argue that it's not going to happen as quick as possible. We'll see what the Fed does. But that would be the argument that if interest rates do go down, then bond prices would go up. But I tend to agree more with what Warren Buffett. In fact, if you think about what the legends of investors have to say, it's well worth listening to some of the legends that's out there. And I would consider Warren Buffett, a legend of investing. Mm-hmm. With bonds, the other thing that people do is sometimes they want to chase the yield, meaning they want to go into some of these bond categories that pay a little bit higher interest. And if you look, again, using the aggregate bond index, That yield right now is somewhere in the 4.8% range. And other investors, what they want to do is they want to try to get some of these bonds that yield 6, 7, 8% yields that are out there. And what that means is that they're going into more risky bonds. These are bonds that typically don't have as high of quality credit. And so if and when times get tough, you have a risk associated with that. The third category that's an issue is, some of the bonds have a call feature, meaning that you might have bought a bond that you thought you were going to have for a set period of time, and all of a sudden that bond gets called on you, and now you've got to reinvest it at what could be a lower interest rate. The fourth category is if you look at currency risk overseas, if you have foreign bonds in the portfolio. So, when you add these all up, that's why Warren Buffett talks about bonds coming with a warning label. That's the warning label. So what can you do as an investor? First of all, look at your 401k. If you have a 401k and you have a target date retirement account inside of there, and you're within 10 years of retirement, we really have to talk. We can show you our system on how to maybe pick an investment in your 401k to eliminate some of the risks that you have associated with it while still giving you some peace of mind. Now, how can you do that? In a 401k, you could have a stable value account. But what about us as other investors? So maybe, you're close to or in retirement time. Maybe you don't have a 401k anymore. Instead of bonds, what could be the other alternative? Number one, money market accounts. I still really like, the interest rate that we're seeing today. Talking about my son graduating from college, he's 20 years old, but we haven't seen money market accounts pay the rates that they're paying today. So for your liquid short-term money markets are great to look at. For money that you can set aside, in my opinion, anywhere from 6 months to 2 years, good old FDIC insured CD rates are really fantastic today. And for those of you that want to lock in rates, 3, 5, 7, 10 years, the insurance companies of America offer a product called a fixed and indexed annuity. And those rates are also still pretty competitive today. So the question about bonds is determining whether it's right for you. And if you really want to know, do you have the right investments? What you want to do is you want to get together with our office, America's Retirement Headquarters. And what we can do for you is we can do the Retirement Team Action Plan. Within the Retirement Team Action Plan, we're going to provide you with that independent portfolio analysis, and we're going to show you where the strengths and potential weaknesses are in your portfolio. And then we're going to give you some specific advice about if and when there should be changes made. What do those changes look like, and what is the pros and cons of that? So that Retirement Team Action Plan is a way to determine, are you owning the right investments, or should you be taking advantage of something else that's out there?
So if you're worried about, market performance affecting your overall balance, but you haven't really looked at your quote unquote, the safer side of it in bonds, might be a good time to take a look at it. And then if you find out that you are overextended or overallocated, finding out how to reallocate that. It is part of the Retirement Team Action Plan that the team at America's Retirement Headquarters can do for you. If you need a second set of eyes on it just to see what you have, pick up the phone and give a call, 419-794-3030. Once again, that's 419-794-3030. You can also visit them on the web. That's arhq.com. Now, at what age do you think you'll retire? A new survey by the EBRI, the Employee Benefit Research Institute, found that 28% expect to retire at age 65, which is up from just a year ago. But the median actual age for retirement has been 62. So there's a little bit of a difference there. Is it common for clients to pick a retirement date and then have to move it up? What advice would you give someone who has to deal with a retirement that might be put on them earlier than expected?
That's a great question, Chris. And Nolan, I actually have a couple of examples for this. I had a client that actually came in. He attended one of my Medicare educational events and came in. We had our initial appointment. He said, I'm not really looking to retire. I'm turning 65. He actually turned 65 this past April. And he says, I enjoy my job. I'm still going to work, and I really don't have any intentions of retiring for at least another 2 or 3 years. He says, but unless my health changes or they decide they don't want me anymore. Well, the crazy thing is, he reached out to me the end of April and said, well, guess what? They decided they didn't need me anymore, and now I have to sign up for Medicare, and they are forcing me to retire. So that happens a lot. And this guy, fortunately for him, he was at 65 years old. But we've also had people that are either forced to retire due to health or due to force because of cutbacks in employment. I know we saw a lot of that during COVID. Back in 2020, we saw a lot of people that were actually kind of forced out of retirement. And then, quite frankly, we just saw people that said, I'm done. I'm burnt out. When I lost some of my coworkers during COVID, I'm now doing the job of 3 people. I'm burnt out. I can't handle this anymore. So one of the things that I really help a lot of these people with is obviously signing up for health insurance. If you're under 65 years old, your options are 1, Cobra. And people say, well, Cobra is so expensive. And I think it's a lot of misconfusion, a lot of people about what actually Cobra is and how it works. It's basically a continuation of coverage. And, it's the same plan that you had on your employer plan, when you were working. It's just now you're paying all of the premium. Or you can sign up for the marketplace. And, like I like to refer to it as the Unaffordable Care Act, because that's your only 2 options. So if you're under 65, that's what you're faced with. Over 65, we can go ahead and sign you up for Medicare and get moving on that. But, there's a lot of items here on this list that we have in front of us on what to be prepared for and how you can be proactive and prepare for that unforeseen forced retirement. We always say be prepared. It's the Scouts honor or the motto is be prepared. And if you're not, and you're all of a sudden you're thrust into that situation where, oh my gosh, now what am I going to do? I have to retire. Nolan, why don't we go through some of these on the list?
Yeah, I think the first thing is if you're in a forced retirement situation, first of all, take a deep breath.
Yes.
Take a deep breath and don't make any major financial decisions until you have a plan in place. So, people think, oh my gosh, I lost my job. I've got to cash out my 401k and pay off my mortgage, or I've got to do this or that. And as you point out, if you're pre-65, your health insurance cost is income, not an asset-based test. So if you cash out those investments early, you could face tax penalties depending upon what your age is. You could face normal income taxes. You could face higher health insurance costs. It can be a compounding bad snowball effect in a forced retirement situation. That's where, as you talk about, the first thing is after you take a deep breath, again, I'm biased. You should talk to a financial professional. What we would do here at our office is we would put together a retirement team action plan for you. In that retirement team action plan, we're going to look at your taxes. We're going to look at estate planning. We're going to look at asset protection and money management. Assessing your financial situation is going to allow you to evaluate what those financial resources are, including your savings, your investments, maybe any other retirement accounts, and then, determine how long those funds are going to take to be able to accomplish those goals. In our process, it's called the independent income system. We're then going to break it down into different time frames. So if this forced retirement is at the age of 62, we're going to develop one plan from age 62 to 65, looking at things like navigating the healthcare environment for affordable healthcare. Then once you get to 65, you go on to Medicare, and also during that 62 to 70 year time frame, it's answering important questions like Social Security. Another big mistake that people can make is if they're forced to retire early at 62, they might say, well, I better just start Social Security.
Right.
What they don't realize, though, is that by selecting Social Security at 62, what you're effectively doing is you're accepting a lifetime penalty and reduction of benefits that not only could impact yourself, it could also impact your spouse, depending upon what your survivor benefits look like. So the second thing is usually if you're forced to retire and it's not your decision, maybe the company made a decision, there's going to be understanding things like the severance benefits. There's usually, depending upon that, things that are coming into place, such as severance pay, what your continuation of health insurance looks like, or maybe any other benefits that are all from there. The review of the investment accounts, there might need to be a mind shift. There might need to be a change to what the allocation is, understanding the rules of how you can take withdrawals out from a 401k versus an IRA. Withdrawals typically are different age time frames. with how penalties apply, and it's different from a 401k and an IRA. If you're blessed enough to have a pension, you're then going to need to look at making some decisions of when to start the pension. Do you take single life? Do you take joint life? Do you take period certain? What does that look like? Never a fun exercise, but getting a handle on what your budget looks like, looking at what your expenses are. There is an area where we can go down the punch list. So in different situations, I think maybe eliminating some of these smaller balance debts could make a lot of sense for people. Maybe they have 3 or 4 different credit cards that have a couple $1,000s of balance. There you might argue, let's just eliminate those debts and put them to rest and get them out of the way.
Nolan, I can tell you this. I've actually changed my internet provider. We're doing a little bit different things with our cable. And it was shocking to me, and I'm not proud to admit this, but I went through and discovered that I was paying $210 a month in subscriptions to different streaming programs, right? That ties right in with your budget, right? I mean, you're going to have a mindset change, and we can help you figure out what budget items you're willing to give up. And the one important thing to remember is we understand that if you're forced into a retirement situation, your mindset's going to be a little different. And we understand that. And we're going to not offer, a plan that's not going to work for you.
Yeah, we're going to address the situation right now and be able to, cross the T's and dot the I's. Again, as America's retirement headquarters, dealing with the loss and unexpected loss of a job is something, that we've dealt with hundreds of families here in Northwest Ohio. And it all starts with getting that specific plan, which is, our unique approach is called that Retirement Team Action Plan. And then once you leave here, maybe you'll find out forced retirement's not a bad thing.
Yeah, exactly.
You get to enjoy the summer if the numbers all work out. If not, maybe there's some adjustments that need to the plan. Maybe you don't have to work full time. Maybe just going out and looking for generating additional income and finding some type of part-time work, consulting or freelancing could be a good option. But again, unless you get that retirement team action plan, you probably don't know. And the last thing we want you to do is make a financial mistake that becomes an irrevocable decision that can cost you a lot of money, that significantly increases the risk of you outliving your income.
And if that retirement is thrust upon you, whether it is layoffs or health care issues, the chances are that you're going to make a decision pretty quickly, and that is when those mistakes do happen. So as the Boy Scout motto is, we're going to keep coming back to it, be prepared. Know that regardless of what your plans are in life, retirement is probably going to be happening at some point in your future. Go and put a plan in place now. You'll be able to navigate it as it comes along, hopefully on your own terms. It all starts with that phone call. Find out more about the Retirement Team Action Plan by giving a call to the guys at America's Retirement Headquarters, 419-794-3030, or go into the website, arhq.com. I saw someone who had written in an advice column on Market Watch, written to an advice column with an inheritance question. He took out a loan from his mom for $20,000 back in 1996, but only paid off $5,000. After his mother passed, he found out that she had deducted the entire loan from his inheritance, even though he paid off a quarter of the money. Now he wants to know how to fix the mess. If this gentleman came into your office and had this question, what would you tell him?
Well, I think a couple different things. In 30 years of experience and personal experience, number one, don't give loans to family member. It usually doesn't end well.
Right, exactly.
If you have the money to give it, and you can give your money away now, go ahead and, give it to them without that expectation of getting paid back. Because I've seen so many situations, again, that things get awkward at the Thanksgiving table or at Christmas because somebody loaned money back and they're like, why is Timmy getting some Christmas presents when you couldn't make your payment to me this month? Those are awkward conversations with families. I know parents are trying to do the right thing, again, with giving these loans. But usually, again, loans don't work well. If you can give the money to your child and it doesn't hurt you financially and you still have enough financial resources to live money comfortably for the rest of your lifetime, then give it away without that expectation. Secondarily, the gentleman who wants to fix the mess. So in 1996, he borrowed $20,000, paid $5,000. You know what mom could have made on $20,000 since 1996?
A lot of money.
I'd say pay it up, buddy.
Yeah.
It's coming out of your estate. It certainly should. But here's the thing. in this situation, it seems like a lot of poor communication. And we see this happen all the time. In fact, if you're a listener, you probably can think of 4 or 5 examples of your own of situations where families got blown up when a loved one passed away because there wasn't good communication. I know even in my own family, with my parents got divorced, my dad got remarried, and only a few short years later, at the age of 49, my dad passed away of a heart attack. In that blended family, I still feel like there wasn't clear communication on what his ultimate estate wishes were, which caused a lot of friction for a long time. I was a young kid. I really had to learn a lot and grow up. And I just, sometimes say, I wish I would have known what Dad's wishes were.
Yeah.
And so if you have an estate plan and it's, old, got that estate plan, you're like, we did it when the kids were little and now your kids are 30, now's the time to revisit it. Even if you have an estate plan and you haven't pulled it out and looked at it in the last couple of years, what I would say in my experience by going through this ultimate estate planning checklist is 9 out of 10 times I'm going to find something in there that is a mistake or a potential mistake that could catch people off guard. It's, again, not having the correct language in there. It's not naming a properly named beneficiary. We're not attorneys, so we're not trying to give you legal advice. What we're trying to do is we're giving you advice that says, here's the type of things you need to think about that we've learned from 30 years and hundreds of families. And unfortunately, dealing with retirees, we have families that we help through this transition plan. And those families who have clearly communicated what their wishes are tend to be families that can not only pass wealth on better, but families that can stay together when things get tough versus these families that get blown up. And again, one of the ways that you can do that is we'll go through that ultimate estate planning guide. Within that ultimate estate planning guide, we've got the things that we've thought about, like what you talked about with Dad, finding where his passwords are, who are his key professionals to reach out for, identifying, some of the questions to ask yourself, like, do you know what the 5 things are for a properly named beneficiary form? Those are all the things that are included in that ultimate estate planning guide, which is one section of what we do here at America's Retirement Headquarters, which is our retirement team action plan. In that retirement team action plan, we're going to look at taxes, estate planning, asset protection, and money management. And all those areas can help you make sure that you don't have an estate plan that creates family disagreements.
The one thing, coming back to this, and that's great, Nolan, and that's why I'm here, is because of the team approach. It's phenomenal, and people that come in here always comment on how they like everything being right here so they can get everything taken care of. But one thing, what I see here is, what kind of advice would we tell them? I think one of the big things that I get from what you're saying, Nolan, is, don't loan money to family. So if you properly communicated and maybe advice to this particular mother, not necessarily the son, but the mother would be, if you've got the resources available in your assets, let's take that 20 grand and give that 20 grand to him and communicate properly to him that this will at some point come off of your inheritance. Then he knows that when that time comes, he's not expecting to have this fight, and he's not expected to pay it back because it was a gift that's taken out of the inheritance. So like you said, proper communication can really avoid a lot of the confusion and heartache.
As the saying goes, an ounce of prevention is worth a pound of cure. And the loss of a loved one is already an emotional time with the gravity that brings. If there is financial uncertainty or financial turmoil that could add further conflict, it could be avoided by having a proper plan put in place. That's part of the Ultimate Estate Planning Checklist. It's part of the Retirement Team Action Plan, and you can have it all put together for you by reaching out and scheduling a time to speak with America's Retirement Headquarters, 419-794-3030. or the website, arhq.com. Now, guys, I don't know if you are aware of this fact, but this coming November, we're having an election. Americans, they're going to decide between Joe Biden and Donald Trump for president, and the two hardly agree on anything except Social Security, with the program's trust fund due to run out of money as early as 2034, triggering a possible 25% cut in benefits. Both Biden and Trump are promising to protect the program and not slash it, but neither has really offered up a detailed plan. So there you go, more uncertainty in the books there. What should people who have not claimed Social Security yet do in the next 10 years to protect themselves?
I really do think we are in danger of losing some Social Security. It's a matter of figuring out how it's going to be. If you look at it, we've talked on this topic over the years. In fact, if you go over to our YouTube channel at America's Retirement Headquarters on YouTube, you'll find that a lot of these topics that we talked about, we had a caller that had called the office after we discussed the risk of Social Security several months ago, and he was really upset in the fact that he said, I've paid in all this money to Social Security and, I deserve to get what I deserve. And look, I love this country. I believe in America. I served in the United States Marine Corps. It's the greatest country ever. But, our political leaders have kind of led us astray, and they've created this problem. But you can't ignore it. You have to say, well, how does it apply to my situation? And, what can I do and can, make a decision that you can take control over? First, let's look at this. They're talking about the fact that they can only pay 75 or 80% of benefits in 10 years, right? Now, think of how fast this year has already gone.
Sure.
10 years is not that far. And every time they come out and report these numbers, it seems to be a little quicker in the past. So let's use the past to figure out what could be potentially the future. So the question is has benefit cuts been done so far in the past? Maybe not physically coming in and saying, if you're getting $2,500, we're going to reduce it and pay you $23,000. But here's the way that benefits have been cut so far in the past. First of all, what they did is they have made changes to the full retirement age. The full retirement age used to be at 65 for some people, but it gradually increased to 66 or 67 and potentially higher depending upon your year of birth. Next, what they did is they monkey around with the adjustments of what's called the cost of living. Yep. So within the cost of living, there's two items that they remove in determining what the Social Security cost of living index will be. And I don't know if you as a listener know what they are, but it's food and energy. And if I think about a senior or retiree, food and energy have been a major inflation factor.
Yes.
And probably hit that age group if you add healthcare onto it as well. Those are probably the three biggest things. So the cost of living doesn't necessarily keep up with what true inflation is on Social Security benefits. Next, if you go back to 1984, a portion of your Social Security benefits became taxable under the federal income for those that they consider to be too high of income. And that number is not very high. So a lot of people, get even more double whammied when they move into retirement and didn't realize that up to 85% of their Social Security benefits can be a taxable income. That's not an 85% tax. That means 85% of it can show up on your tax return. They've made changes to the calculation and the formula. The way the formula is calculated today based upon your average index monthly earnings has also changed over time. Increase in Medicare premiums. I mean, you talk about this on a year by year by year basis, but again, Social Security benefits enrolled in Medicare Part B have their premiums deducted from their Social Security. And number 6, we've talked on Social Security claiming strategies a lot. And one of the things that I have personally seen in the last 10 years is an elimination of a lot of the Social Security claiming strategies. The ways to maximize benefits for your loved one has changed quite a bit. What are your thoughts? As you're talking with different people and you're looking at, Social Security, and I think your goal is 10 years out for for retirement. So,
well, yeah, it is actually. I'm actually 62, so I'm at the age where I could technically take Social Security if I wanted. And we've talked ad nauseum about why you shouldn't necessarily consider taking Social Security at 62. I don't want to penalize myself and sign up for something. Nolan, my perception's a little different. And it doesn't mean there's right or wrong. It's just the way I look at it's a little different than a lot of people in some situations. You've got these people that turn 62 and they say, by gosh, I'm taking it. I paid into it. I don't know if it's going to be there. I want my money right now, right? So they sign up at 62 years old. And then you got the people that say, well, I'm going to wait until my full retirement age because I'm going to work and I don't want to be penalized $1 for every 2 that I make, so they put it off. The way I look at it is this. I love my job. I love what I do, unless for some reason I am forced into retirement. I love what I do. I love helping people. My plan is probably look at taking my Social Security at 70, right? And a lot of people look at me and they say, well, why would you think that? Because what happens if you die and you don't take it? Well, my philosophy is I didn't need it. I mean, if it's something that I needed prior to 70 years old, I'm planning on working. I'm still going to, hopefully make money, and I didn't need to take it. So for me, hey, it's okay for me to wait. I don't care if I retire today, die tomorrow, and never collect that first check. It's okay with me. That's my philosophy. But a lot of people don't have that philosophy. So right now, for me, my full retirement age is 67. That's kind of what I would see happening first, would be probably bumping that back. And I've heard rumors of 70 years old, they're going to bump it back to the full retirement age at 70 years old. Some people I meet with that are signing up for Medicare and ask questions about this, they're perfectly healthy and capable and are 68, 69, 70 years old working today. So I don't see a problem with that. But I do definitely, like you mentioned, increase Medicare premiums. Here's the thing. If you're looking at getting additional benefits, because they're talking about adding dental, vision, and hearing into the original Medicare. Well, if they're going to do that, they're not going to do that for free. The government doesn't do things like that. Right now, the Medicare premiums are $170, $470 for the basic income earners. You add additional benefits in there, you may be looking at $225 coming out of your Social Security right there. So these are all things that are going to happen. That's kind of my take on it. I don't see how they can't do something and make some adjustments, because it's the government and that's what they do.
Yeah, there's going to be some adjustments that come along the way. It's just a matter of them figuring out what that is. And so what you want to do is, number one, have a backup plan and an account that would offer you a future pay raise. And number two is, don't take benefits early and get a lifetime penalty because you feel you better get what you can before it runs out. So Social Security optimization is another area that we really focus on. Mm-hmm. And, we can help take and show you what the numbers are, and even show you what an impact would look like with a reduction, so you can make the best educated decision about what's right for you versus making an emotional gut decision. So you got to get it right, and a Social Security optimization report is the way to do that.
And it's easy to get. All you have to do is reach out, 419-794-3030. Will there be some sort of resolution to this Social Security looming problem prior to 2034? I could say with fairly amount of certainty, I think, yes, they will find a way to resolve it. What that's going to look like, I don't know. Will it be prior to 2033, 2034? Again, I could say with some certainty, probably not so much. But control what you can control. Have a plan in place for now, and also the future. The team at America's Retirement Headquarters can help with that when it comes to Social Security and many aspects of your retirement. All you have to do to get started, go to the website, arhq.com, or give a call, 419-794-3030. Now, guys, I think we should buckle up for a noisy summer. At least 17 states in the eastern half of the country, they're being invaded by a trillion, with a T, cicadas.
If y'all never knew what cicadas sound like, this is what they sound like. There's thousands of them. It's where two different broods of cicadas, the 13-year ones and the 17-year ones, are all coming out at the exact same time. And then they get their wings. They fly up to the treetops. They lay their eggs inside the tree stems. The eggs drop down to the ground. And then the little nymphs, they crawl under and find a tree root to suck on for another 13 years. And the whole cycle begins. You come, you sing a song, and you mate, you lay your eggs, and then you die.
So essentially a 6-week retirement plan after emergence. That's easy, I think. But let's talk about the human lifespan. How do you guys plan for retirement to cover for someone to live as long as they expect to?
I really like this topic. I mean, we get a lot of people that will come into the office and they'll talk about how They're going to start Social Security early because nobody in their family lived past age 75. But on the flip end of the scale, we do run into people that have, great health, longevity. I can think of a couple clients that come to mind that, one is in their 90s, and I'd be like, no way, you've got to be in your 70s. I mean, these people just, have making good decisions about their health. They're staying active. Their mind's there, their body's there, and it's going to be here for a long time. So I met with a lady recently, Robin, and she was mentioning the same thing. She says, looking at my financial plan, the default is age 90, but, my mom's 95 and she's still healthy as can be. Let's adjust the plan and look at it. And so when we adjusted the plan for Robin and we took a look at it, one of the things that we wanted to do is we wanted to make sure that she had built in enough what I call reliable income that she had her minimum monthly income needs taken care of. So when you look at reliable income, that's things like Social Security, pension, or annuities. And the other thing that you want to do is you want to take advantage of the current rates. In fact, she had come in for a second opinion. She already had another advisor. She bought an annuity several years ago, and that annuity was designed to give her income when she retired at 65, and it gave her that peace of mind. But because of where higher rates are today, we can get her the same level of income today by only using 60% of the account because rates are up so much higher today. That freed up 40% of her money that she could do for other things, fund money accounts, things like that. I'd also say it's important not to overspend.
Sure.
If money is going to last for 20, 30, 35, 40 years, you want to make sure that you're overspending your fund money in those years that they overachieve the goals. But unless you have that reliable income source, be real careful. Identify and eliminate some blow-ups. When we think about blow-ups, there can be a couple of different ones. One is you could have the blow-ups of having too much money in the stock market and the market crashes like right away or right in early years of retirement. On your side, looking at like healthcare blowups, you can see that wipe out a family pretty easy as well.
Yeah, you if you don't have the right plan put in place and you have a catastrophic claim, you absolutely can have a blow up of unexpected proportions, and it could change the entire trajectory of where you're going. The one thing I would also add to that, Nolan, is when you look at, I've got a client that his mom and dad both lived well into their 90s, and he is an absolute twin of his dad, and he's 70, I think he's 72 years old right now. He's very active in golf. He's very, very healthy. And, I would think that a mindset would have to be, when you talk about don't overspend, I might want to change my thought process because, man, if I look at mom and dad, they were 96 and I think 98. He's still got 20 some years, 24, 25 years left of life. If he blows through all of his money, well, what's he going to do? And you got to be aware of that. A lot of people don't think about that kind of stuff. It's like, oh my gosh, on the flip side, don't go blowing all your money because mom and dad died in their early, 60s, right? But you got to be prepared for that.
And then the fourth item is really got to just monitor and adjust along the way. So based upon what the economic conditions are, you want to get together and you kind of want to review those type of things and take a look at them. One of the biggest concerns for a retiree is outliving their income, whether, you lived 75, 85, 95, or 105, that's still the biggest fear for a retiree. And the way that you can address it is, again, go through the retirement guys. It's the retirement team action plan. So in the retirement team action plan, what we're going to do is we're going to walk you through our philosophy that's called the independent income system. Within the independent income system, what we're going to do is we're going to show you how to, create a bucket of money for that reliable income. We're going to talk to you about what the different options are, how to try to look at maximizing each option and having enough minimum monthly income that lasts forever. We're going to look at things like your estate planning, have those documents in place. look at your areas of taxes. One of the biggest threats for a retiree is the issue of the unfunded liabilities that our country has and the out of control spending that they have. So a retiree that wants to live a long time really needs to kind of hit taxes head on.
Sure.
And take advantage of the current tax law. And then the money management will walk you through that approach and give you, some ideas on, where do you put the safety part of the portfolio and where do you put the growth part of the portfolio. It's all, again, in that retirement team action plan and help you create that retirement plan if you expect to live a long lifetime.
People living longer, the increased longevity that we've seen, generation to generation is a great thing, something that should be celebrated. But if we're talking about the fact that we're now going to have to fund more years in retirement and, whatever may come to the line, market volatility, tax increases, things like that, it can give people cause for concern, I think duly so. But if you have a plan in place, hopefully laying some of those concerns and those fears to bed, that is what the retirement guys do. That is part of the retirement team action plan. And if you have those concerns about, longevity and what that could entail for your retirement, pick up the phone, give a call, and schedule a time to speak with them, 419-794-3030. Or you can always go to the website, find out more about Nolan, Scott, and the entire team at arhq.com. For the last few years, we have heard the phrase soft landing a lot. It happens when the Fed raises interest rates slowly to fight inflation without causing a recession. But JP Morgan CEO Jamie Dimon offers this gloomy outlook to the Wall Street Journal.
Things may not go as well as people expect. The odds of a soft landing, the market kind of prices in 70%. I think it's half of that. As a business person, I try to be prepared for all of that. It looks a little bit more like the 70s to me. And I point out to a lot of people, things look pretty rosy in 1972. They were not rosy in 1973. So don't get lulled into a false sense of security because the today looks okay, that tomorrow's going to be okay. So just trying to separate the two.
There's that Boy Scout motto again, be prepared. Do you agree that there's a false sense of security about the economy? What are you telling clients who might be raising these questions with you?
Well, Jamie has had a kind of a negative outlook on the economy for a little while now. And, it kind of depends on who you listen to, whether it's our show or somebody else's show. I do think that I would agree with the one thing that he said, which is to be prepared. At some point, our economy is going to have a tough time. So the more that you can get prepared now, whether it's a recession, a market crash, something will happen in this economy. The problem is if you listen to the negative news headlines, it oftentimes will lead people to make poor investment decisions and or emotional decisions. Now, let me give you an example. My son, who many of you know, has been working at the office the last couple of years, recent college graduate from BGSU, now, a full-time employee of here. But a few years ago, when the market was down, I remember him coming to me and showing me his 401k statement and saying, Dad, this stinks. Look how much money I lost this year because the 401k was down. He's invested in all equities. And I said, hey, buddy, you're 19. You don't really need this money until you're 60. And so if anything, just increase your contributions. And, if we look at the market over the last couple of years since that time frame, it's been such a smart decision. So number one, know that there is always a reason to not invest or stay invested. For long-term investors, ignore the short-term noise. In fact, I even think for, people that are close to or in retirement time, you've got to turn off the market watch news and, keep track of everything. There's no point in looking at your financial accounts on a daily basis. If anything, turn the travel channel on. But taking what Jamie had to say and then taking that a step further and saying, okay, where are we at in the economic cycle? If we look at the rules of investing, it's pretty simple, right? Buy low, sell high. Mm-hmm. Now, I know right about now the market is close to an all-time record high. So while the market is at a high point, I would say in looking at it, considering adding in a downside risk management system. We had somebody had come into the office the other day and they were just transitioning into retirement time. And they wanted a second opinion because they had expressed to their financial advisor that, having all of their money in the stock and bond market, they just weren't comfortable with that anymore because they were now transitioning into retirement time. And their advisor just said over and over, over the course of time, don't worry about it. It'll be fine. Just let it be. And so that set it and forget it mentality of leaving it up to the lottery of the returns of the stock market just didn't resonate well with them. And I asked him that question. And I'll ask you, if you're somebody that has, a significant amount of money, $250,000 or more, or $500,000 of saved up money in a retirement account, what is your current downside risk management system? If and when the market goes down, what is the strategy that's going to be designed to protect you from what we have experienced in the past, whether it's a 2008 50% decline that we saw, or in the 2000 crash that we saw a 50% decline? And do you now have the luxury of time to make up for it? Because it's not 2000s anymore. It's not 2008. You're probably closer to retirement time. What we do for our clients here is we can incorporate what I would refer to as circuit breaker technology. So in some of our strategies that we have a clear exit strategy that says, if this happens, we're going to take steps to reduce risk overall in a portfolio. And that could mean reducing equities and going, more to cash or somewhat of a defensive position. So while the market's at an all-time high, enjoy it. Enjoy it. And, if you're ahead of your goals, maybe protect some of your winning, but don't let this be a false sense of security. Whether it's a soft landing, a hard landing, higher interest rates, lower interest rates, I'm telling you, at some point, the market will have a hiccup and the market will have some type of decline. And so the way that you get prepared for that is run the fire safety drill now. And what we can actually do for you in our retirement team action plan is run that fire safety drill. In the retirement team action plan, what we're going to do is we're going to take your current portfolio and we're going to put it all together. And what it's going to do is it's going to give a number nerd like me the analytical data, be able to have an intelligent conversation with you that shows, what would be your normal range of returns in your portfolio over a 6-month time frame. And then what we can do is we can take your portfolio, make it jump up on the treadmill and stress test it. We can say, well, if we have another 2008 market crash, what impact and what is the maximum drawdown that you could have in your portfolio? And then after looking at those numbers, if you're not comfortable with what those numbers are, then we can help you make a smart, intelligent decision before a panic situation sets in about incorporating some downside risk management. The mistake that the average investor makes is they wait till something bad happens. Folks, don't wait till something bad happens. Again, reach out to us, get that retirement team action plan, and we'll walk you through developing a downside risk management program in your portfolio if that's something that is keeping you up at night.
You don't want to necessarily go and get an insurance policy if your house is on fire. Quite frankly, you're not going to be able to. You don't want to hope that you got that fire extinguisher the minute that something boils over on your stove. You don't want to have a plan put in place once the market is already taking its downturn. You want to, again, going back to that Boy Scout motto and over again, be prepared. Know that there will be market fluctuations. Market is going to go up, is going to go down. Perhaps right now is a great time to look at maybe reducing some of that risk that you've got and hopefully avoiding a bigger risk to your retirement plan. It is all part of that retirement team action plan, and the team at America's Retirement Headquarters can help put that together for you by reaching out 419-794-3030. You can go to the website arhq.com. A lot of great events coming up. You can check out all that and go ahead and reserve a seat for those at the website arhq.com. And once again, that number 419-794-3030. Want to thank you, as we always do, for joining us here on America's Retirement Headquarters. Nolan Baker and Scott Kershner. Hope you have a great week ahead of you. Stay safe out there. Gentlemen, appreciate the time as always. And as we wrap up, I want to leave you with the final word.
Yeah, again, as we started out in the beginning, I just want to tell all the mothers out there, happy Mother's Day. We really, really do appreciate you. I am blessed in the fact that I get to be Disney dad, and I know, my wife does the brunt of the work around the house, and we really appreciate you. So when you think retirement, think America's Retirement Headquarters and know that we're thinking about you. Have a great week, and we look forward to seeing you next week.
America's Retirement Headquarters is located at 1700 Woodlands Drive in Maumee, Ohio. You can reach them by calling 419-794-3030 or online at americasretirementheadquarters.com. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Nolan Baker is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstance. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Nolan Baker, Ohio Insurance License Number 27787.